Okay, let's dive right into this. Welcome to another Deep Dive Explainer. Today, we're taking an institutional-grade look at a truly fascinating company, one that literally powers the Indian manufacturing sector from behind the scenes. We're talking about Grindwell Norton. We're going to break down their unique economic moat, analyze a massive inflection point we found in their cash flows, and then we're doing a hard reality check on their valuation to see if this high-quality giant is actually worth its premium price tag.
But first, before we get to the numbers, a quick disclaimer. Welcome to Stress-Free Investing Analysis and my personal notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
All right, here's our stress-free roadmap for today's explainer. We'll start with the abrasives giant itself, map out a massive cash flow surge, hunt for some hidden gems and red flags, do a strict valuation reality check, and wrap it all up with our investment thesis.
Section 1. The abrasives giant.
If you've ever seen metal cut, ground, or polished in a factory setting, chances are Grindwell Norton was involved. Grindwell Norton, or G&O, is India's absolute market leader in abrasives. But what really makes them special, what their real secret weapon is their parentage. They're heavily backed by a 51.6% stake from the French global giant Saint-Gobain. Saint-Gobain is the world's largest abrasives manufacturer, generating over 46 billion euros in global sales. This essentially gives G&O an almost unfair technological advantage in the Indian market.
But here's the thing. If you break down their FY25 revenue, you'll see they're way more than just a pure abrasives play. While the abrasives definitely remain their core engine, bringing in 1,402 crore, their ceramics and plastics division is right behind it at 1,171 crore. They even have an IT segment called Indec that provides captive digital services back to their parent company, pulling in 184 crore. So they've successfully evolved into a highly diversified industrial consumables platform.
And this brilliantly illustrates the foundation of G&O's wide economic moat. It's like a fortress. First, they get direct access to Saint-Gobain's global R&D pipeline, which literally keeps them 3 to 5 years ahead of their local competitors. Second, they boast an incredibly sticky, decades-old distribution network across India. Third, they've strategically backward integrated through a key plant in Bhutan to secure raw materials. And finally, to fight off those cheap Chinese imports, they're intentionally shifting away from low-end tools toward high-end, precision industrial solutions.
Moving right along to Section 2, the cash flow surge. This is a massive turning point for the financials.
Just look at this trend. Tracking their free cash flow reveals a dramatic step change. In FY23, it was a pretty modest 72 crore. In FY24, it jumped up to 199 crore. And by FY25, it surged to an impressive 366 crore. That is an enormous structural improvement in their cash generation. Now, what's really interesting about this slide is the why behind that surge. G&O just finished a multi-year intensive capital expenditure or Capex cycle. We know this for sure because their capital work in progress literally collapsed from 127 crore down to just 25 crore. The heavy lifting is done. Those new assets are now operational, they're ramping up, and they are generating serious cash, which has pushed their free cash flow yield up to 1.7%.
And because of this surging cash flow, G&O is now sitting on a massive net cash position of 1,069 crore. Just to put that into perspective, that's about 5% of their entire market cap just sitting there in cash and mutual funds. So it really begs the question, how is management going to deploy all this capital? Are we looking at a special dividend, an acquisition, or maybe a value-accretive buyback? It's absolutely a key monitorable going forward.
Which brings us to Section 3, Hidden Gems and Flags. Time to put on our investigator hats and dig into the footnotes of the annual report.
While we were digging, we found an absolute hidden gem, 72%. That is the massive year-over-year revenue growth of G&O's 70% owned subsidiary over in Bhutan, which manufactures silicon carbide. Not only did their revenues surge by 72% to nearly 92 crore, but their profits multiplied 8 times over. This strategic backward integration is securing crucial raw materials for G&O, and it is paying off beautifully.
Now, on the flip side, we always run the financials through the Shillett forensic framework to check for any earnings manipulation. The good news? The Benish M score is a solid green, indicating very low manipulation risk. Their revenue recognition is totally clean too. However,
we did spot two amber flags that demand our attention: an issue with their ERP database logs and the specific structure of their indexed IT revenue.
Let's unpack those flags, maintaining a purely objective stance here. First, for the second year in a row, the audit trail wasn't enabled at the database level for their ERP system. Honestly, for a company of this size, that's a governance gap that really needs closing. Second, their payables to small MSME vendors actually doubled to 16.4 crore, which is a sign they might be stretching out payment terms with their smaller suppliers. And lastly, as part of being a Saint-Gobain subsidiary, there is a royalty drain of 44.5 crore flowing straight out to the parent company every single year.
And that brings us to the ultimate conflict of our analysis today. Section 4, Valuation Reality Check.
Look, we've clearly established that Grindwell Norton is a tremendously high-quality business. Wide moat, zero debt, booming cash flows. But you, as an investor, have to ask yourself a very simple question. Is the price actually right?
Let's move to the numbers and see how this builds out when we compare GNO to its peers. GNO is currently trading at a steep price-to-earnings ratio of 52.2. Its biggest rival, Compagnie, trades at 40, and Went India trades at 35. Now, GNO commands this premium because of its Saint-Gobain tech access and a really solid 21% return on capital employed. But 52 times earnings? That is pricing in a whole lot of perfection.
The reality check really hits hard when we run a discounted cash flow model. Our base intrinsic value sits at roughly 673 rupees per share, but the current market price is hovering way up around 1958 rupees. To justify that current price, the market is assuming GNO will achieve an 11% perpetual growth in free cash flow forever. That is a massive gap, and it tells us the stock is currently quite expensive.
So, where does this leave us? Let's wrap up with Section 5, the stress-free investment thesis.
So, the crucial takeaway is this. Grindwell Norton scores brilliantly on business quality, earning 16 out of 20, and it shows incredibly robust financial health. But it takes a massive hit on valuation, scoring just 7 out of 15. This gives the company a total stress-free score of 70 out of 100. It's essentially an A-grade business that's currently trading at a C-grade price.
Ultimately, our verdict here is to hold your existing positions, but look to accumulate aggressively on dips. The target entry zone that provides a real margin of safety sits right in the 1,600 to 1,700 rupee range. To monitor this thesis going forward, watch for a bull catalyst like a Phase 2 expansion of that highly profitable Bhutan plant. Conversely, your bear trigger to exit would be if Chinese competition forces their abrasives operating margin to dip below 10%.
Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed companies should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing. I'll leave you with this final thought. Is the safety of the Saint-Gobain moat really worth paying for a lifetime of perfection? Let me know what you think.